This is going to be a very interesting session because you are going to understand the difference between depreciation and impairment loss. Let's get started. Imagine a company is purchasing a machinery. The original cost is 10 lakhs. Expected salvage value at the end of its useful life of 5 years is 1 lakh. So this asset can be depreciated over a period of 5 years using this straight line method formula. So we can calculate depreciation as per straight line method, which is original cost minus salvage value divided by useful life. So 10 lakhs minus 1 lakh divided by 5, and that gives you annual depreciation as 1,80,000. This means every year this 1,80,000 will be charged as expense in the name of depreciation, and it will be taken to the statement of profit and loss, and that will reduce the profit of the business, and this charge will reduce the value of this machinery every year. Let's have a look at it. Look at here. Year 1, the opening balance is 10 lakhs. Depreciation provided is 1.8 lakhs. So 10 minus 1.8, the closing balance is 8.2 lakhs. I can also call this closing balance as carrying amount. Okay. In the second year, this 8.2 is going to be the opening balance. On this, again, depreciation as per straight line method, what we have calculated is 1.8 lakh is deducted. So the carrying amount is 8.2 minus 1.8, 6.4 lakh. For the third year, this is going to be the opening balance 6.4, depreciation same figure, closing balance. Let's repeat it. Fourth year, closing balance is 2.8, and in the fifth year, 2.8 minus 1.8, the closing balance is 1 lakhs. So in the fifth year, the book value or the carrying amount will be 1 lakh, and if that asset can be sold at the estimated value of 1 lakh itself, then the story of this asset will come to an end and there will be no profit, no loss. So here we are providing depreciation every year. What we are doing is we are basically allocating the cost of the asset. Look at here, the original cost of the asset is 10 lakhs, but since out of 10, 1 lakh will be recovered at the time of sale, only the 9 lakh is divided by 5 and it is allocated over a period of 5 years. So this is a predictable amount. We are providing this because we are accounting for usage of the asset. We are accounting for the wear and tear. We are accounting for the obsolescence, right? So everything is predictable, and based on that, we are also reducing the value of the asset year after year. But in reality, everything will not happen in the same way. Here we are saying that at the end of first year, the value of asset is 8.2. End of the second year, it is 6.4. Third year, 4.6. Fourth year, 2.8. And fifth year, 1 lakh. But in reality, it is possible that in the first year itself, the value can come down even below this. In the second year, it can come down even below this because of some external factors which were not predicted. Some external factors not connected with the usage, not connected with the wear and tear. So we have to test for that also. And if there is a drop in value of the asset beyond the expected level, that has to be provided, and that's what we are going to call as impairment loss. Let me show you. Look at here. For year 1, we have calculated the closing balance as 8.2 lakhs. I said we can also call this as carrying amount. So we are carrying this machinery in the books of accounts at a value of 8.2 lakh, and this is what we are communicating to the readers of financial statement, that this entity has an asset worth 8.2 lakh. But we cannot conclude just with this. We have to test for impairment loss. For that, we have to find out what is the fair value of this asset. That is, if this asset can be sold in the market, what value it will fetch. That has to be seen. Okay. Let's say this entity has done that study and found out that it can sell the asset in the market for 9 lakhs. So this 9 lakh is greater than 8.2 lakhs. So good, because here the asset is carried at a value less than this 9 lakhs. But we should not conclude just with this. We should also see what is the value of the asset based on the cash flow it is going to generate over its remaining useful life. So we have to calculate something known as value in use. This value in use is nothing but the cash flows that are generated by this asset over its remaining useful life. So basically, we will be finding the present value of the cash flows, which is arrived by discounting them at appropriate rate, let's say the cost of capital. So what we will do is we will see what is the cash flow generated by this asset for this life. Now I am doing this calculation at the end of year 1. So I will look at what is going to be the cash flows that are going to come in year 2, 3, 4, 5. Okay. Then those cash flows will be discounted at cost of capital. Then we arrive at present value of cash flows for each and every year. Then we total them. And that total will give us what is known as value in use. So in that way, a calculation was done and it was found that value in use is 8.5 lakhs. Okay. So now you have two critical information. One, fair value, which is nothing but the value you will get by selling the asset. And two is value in use. This is nothing but the real worth of this asset, the real cash which you can make in present value terms by using this asset. Now both are in present value terms. That is, they are comparable now. So if you sell it in the market, you can sell it for 9 lakh. If you are going to use it, you will get benefit worth 8.5 lakh. So in this, whichever is higher, that will be considered as realizable value. Okay. So here, if I sell the asset in the market, I'll get 9 lakh. This is greater than value in use. So I can say the realizable value is 9 lakhs. Now let me compare this 9 lakhs with this carrying amount of 8.2 lakhs. In books, I'm carrying it at 8.2. But when I tested this asset for impairment loss, I found that realizable value is 9 lakhs, which is greater than the carrying amount. So there is no loss here. Because in books, I am carrying it at conservative value, which is less than this 9 lakhs. So in year 1, there is no impairment loss. Now let's look at year 2. In year 2, something has happened. Let's say something has happened in the external environment. Maybe the reason can be like this. The machinery, what they are using which they are producing some products, right? And they are trying to sell that in the market. And that product now lost its demand. Why? Maybe because of change in taste of the customer, or because of something even more advanced or better product has come into the market because of even advanced machineries. Okay. So because of that, entire game changed. So there is a advanced or better machinery, and that started releasing different products or competitive products, and because of that, the products produced by this company lost its demand. So when the product itself is not fetching any value, do you think that machinery will fetch any better value in the market? No. Obviously it will come down now, and in future it will go down very drastically. Okay. So here if you look at year 2, the carrying amount is 6.4 lakh, but if you try to sell that machinery in the market, it is expected to fetch only 6 lakh. And if you compare that with the previous year, it's a drastic fall. From 9 lakh, it has come down to 6 lakh. And if you compare it with the carrying amount, again it is lesser. So this gives us there is a issue, or this indicates that there is going to be an impairment. But we should also check what is the value in use. Value in use is nothing but the present value of the future cash flows. The future cash flows are dependent on profits. Profits are dependent on sales, and we have an understanding sales are going to come down. So obviously the present value of future cash flows will also come down. It means value in use will also come down. Look at here, value in use has come down from 8.5, it has come down to 5 lakhs. So now you have two information. One is fair value, the other one is value in use, and already I mentioned for impairment loss purpose, when you compare these two, you have to select whichever is higher as realizable value. So 6 lakh and 5 lakh, if you compare, you get 6 lakh as realizable value. It means you can sell the asset today and fetch 6 lakh. But in your books of accounts, you are already carrying it at 6.4 lakhs. So in the second year, the realizable value is less than the book value, or say the carrying amount. So that indicates there is an impairment loss. Impairment loss is to the extent of 0.4 lakh. That is 6 lakh is less than 6.4 lakh. So let me express this through the formula. Impairment loss is nothing but carrying amount minus realizable value. Here carrying amount is 6.4 lakh, realizable value is 6 lakh. So 6.4 lakh minus 6 lakh, you get 0.4 lakh, and that is impairment loss. So this impairment loss will also be provided in statement of profit and loss in addition to depreciation. So in the second year, this entity will have depreciation of 1.8 lakhs plus impairment loss of 0.4 lakhs, and that will bring down the carrying amount from 6.4 lakh to 6 lakh. And now it's time for us to understand the difference between depreciation and impairment loss. Depreciation is governed by Ind AS 16 and impairment loss is governed by Ind AS 36. This depreciation is a systematic reduction. Already I told you, we are basically allocating the cost of the asset over its useful life because of wear and tear, usage or obsolescence. Whereas impairment loss is not a systematic reduction. It is actually a sudden reduction in value of asset, which may be on account of unexpected events or external factors. If you look at the purpose of depreciation is to allocate the cost of the asset over useful life. Whereas the purpose of impairment loss is to recognize the drop in value of the asset. That is when realizable value becomes less than the carrying amount, then that drop have to be recognized. This depreciation will be recorded every year. But this impairment loss, even though it will be tested every year, it will be recorded only when there is a drop in value of the asset. As already mentioned, depreciation is planned and systematic expense, whereas impairment loss is unplanned. You may not know in which year there will be impairment loss because it is linked to unexpected events or external factors. Depreciation can be calculated using straight line method, written down value method or units of production method. But impairment loss comes into picture only when realizable value is less than carrying amount. Depreciation is an annual expense. It will reduce the value of the asset over time period. But impairment loss is a one-time loss and it will reduce the book value of the asset immediately. If you recollect, here I mentioned 6.4 lakh will be brought down to 6 lakh. So it will happen immediately. If you look into the reasons, depreciation can arise because of usage, aging and all. But impairment loss can arise because of new technology or reduced market demand and various reasons. Depreciation once provided cannot be reversed. Reversal is not possible. But in impairment, reversal is possible. Let's say in 1 year, impairment is provided. Let's take this example. In the second year, there is an impairment loss. And in the third year, let's say something has happened, changed in the market, and because of that, whatever the products produced using this machinery is going to have more demand. Then the fate of this machinery will change. Its fair value will change. Its value in use will change. And the realizable value can even become greater than the carrying amount. So in that case, whatever the impairment loss provided in the earlier year can be reversed. So reversal is possible. So in this way, we have understood the difference between depreciation and impairment loss. So thanks for watching this video. If you liked it, then do not forget to hit that like button, follow, comment and share. And here we go. Credit and Financial Analysis Mastery course. It's a comprehensive pre-recorded online course that comes with 15 modules of video lectures, basically 70 plus hours of video contents, multiple ebooks and reading materials related to credit and financial analysis that will make up another 30 plus hours of content. So totally it is 100 plus hours of learning resources. Then you will also get access to a private community in Telegram for clarifying your doubts in credit and financial domain. Then you also have the flexibility to choose 1-year subscription or lifetime subscription depending upon your learning goals. So by joining this course, you will learn basics of credit analysis, how to read balance sheet, financial ratio analysis, cash flow, fund flow analysis, how to arrive at credit risk rating, how to prepare CMA report, cash budget, how to assess credit facilities like CC, OD, LC, BG, term loan, how to write bank loan proposal, and you will also have access to case studies related to credit analysis. So to join this course, to know more about the course, comment CFA, and I'll share the details with you.